Thank you for taking the time to watch this video. Law firms, like most businesses, want to know where they stand when it comes to profitability, and there are a lot of factors that need to be considered. The model we describe in this video lays these factors out in a clear and concise manner, helping your management team understand not only your firm's current profitability but also helps them make decisions with the key information needed to optimize the firm's future profitability. To save your time, I will cut to the chase and tell you why you should care about this model. First, the model compares key factors influencing profitability based on your firm's specific rules to paint a clear picture of what is helping and hurting profitability. Second, we provide a way to measure not only the overall profitability of the firm, but also the profitability of each office, practice area, billing attorney, client, and timekeeper. We break each measurement down to a per billable hour level, enabling comparison of business units of varying sizes on a level playing field. Taking that a step further, if your firm is considering the acquisition of another firm, then we can build a model with both firms' data based on your business rules to understand exactly how the other firm's profitability compares to your own. The timekeeper return on investment metric shows the profitability impact the types of cases your firm takes has and how its billing and cash collection performance can significantly impact profitability. We built a sample of the law firm profitability model, and one of the views within the profitability model allows for the comparison of business units within the firm. This example view compares the corporate and litigation departments. We wrote a process that allows us to allocate expenses down to every billable hour worked. We added an expense specific to the litigation department where they requested a legal research tool that only benefits their department. Note the entire expense is allocated to the litigation department. We can see that $6.18 of every hour of billed time in the past year was used to pay for the software. This understanding helps the management team understand the impact of the expense, which can be weighed against its benefit. Also note the comparison of the timekeeper's salaries and rent office expense lines. The average litigation department timekeeper's salary per work hour is 18.7% higher than that of the corporate department, and the rent office expense is 38.6% higher than the corporate department's corresponding expenses. Without a view like this, it is difficult to determine how these expenses are affecting profitability. In this example, we go down the line to understand the profitability of two corporate billing attorneys. Partner D had 1,970 more billable hours worked on their cases than Partner F. As a result, Partner D billed $2.4 million, which is $441,000 more than Partner F at a slightly higher billing realization. The purpose of per work hour measure is to create a baseline that provides context where the size of business units vary. It shows us that not only has Partner D accumulated more in billable hours, but they also are averaging $5.24 more per hour in the amount billed. This provides a context to Partner D's 0.9% higher billing realization. While Partner D bills more, they are not very good at getting their clients to pay on time, while Partner F is very good at this. Law firms push hard at the end of their year to collect as much as possible. As a result, the executive leadership team sometimes authorizes write-offs they would not authorize at any other time of the year to push their clients to pay. Partner D was authorized to write off $436,000 to get their collections to $2 million, while Partner F brought in the same $2 million with only $22,000 in write-offs. Partner D's write-off represents $35.17 per billable work hour, while the write-offs associated with Partner F's are only $2.18. Partner D's payments received represent $166.91 per billable work hour versus $196.86 for Partner F. It is good both billing attorneys collected $2 million, but this information shows that Partner F did a much better job of getting full value out of the worked billable hours. The profitability model consistently evaluates the trailing 12 months to make sure major events like this write-off are considered throughout the next 12 months. This helps all involved keep their focus on improving collections and avoiding a similar write-off the following year. The model also calculates the WIP/AR average balance over the past 13 months. WIP stands for work in progress and represents billable hours not yet invoiced, while AR stands for accounts receivable and represents billable hours that have been invoiced but are not yet paid. Understanding how much WIP AR is carried over the year helps us understand how well the firm is billing and collecting. The types of cases the firm engages in also affect how much WIP AR is carried through the year. For example, contingency cases require carrying the WIP AR until the case settles, while other types of cases may be billed and collected each month. Understanding your firm's case mix helps with evaluating the cost of capital and setting cash flow expectations across all of the work done by the firm in a fair and consistent manner. Partner D's WIP AR average balance is significantly higher than that of Partner F, which could be based on case mix, but given both are corporate billing attorneys as well as the write-off, it is more likely a symptom of Partner D's slow billing and collections. Partner D has $255,000 more in allocated expenses than that of Partner F, but if we look at the amount per billable hour, we can see that the variance is only $1.30 per billable hour, or 1.1%. The cost allocation method used is based on the billable amount, and, because Partner D billed $441,000 more than Partner F, their allocation dollars are higher, but in the same ratio as those for Partner F. If we dig deeper, there may be out-of-range expenses between the two, but overall, they tie, so it would not be the first place I would look. Now we reach the profitability metrics, and the first metric is WIP AR turn. The way to read the metric is that the higher the number is, the better job they are doing of keeping the time frame between when work is done and when it is paid as short as possible. That means Partner D has a much slower time frame from work date to payment date when compared to Partner F. The profit margin is calculated by taking the payments received and subtracting the total allocated costs. We can see that Partner F has nearly a 12% higher profit margin percent than Partner D. The profit margin numbers answer two questions. 1. How much did we make based on the payments we received? And 2. How profitable were we with expenses considered? It does not answer the third important question when considering your return on investment, and that is, how much did we have to carry in WIP AR to bring in those payments? This is where the timekeeper return on investment comes in. The timekeeper return on investment is calculated two different ways. The first simply takes the payments received and divides it by the average WIP AR, and the second subtracts allocated costs from the payments received before dividing by the average WIP AR. We calculate the timekeeper return on investment with and without costs as separate metrics to make it easier to see the effect of the costs on profitability. When all factors are considered, it shows that there is a pretty big difference between the profitability of Partner F and Partner D. Partner D definitely thinks we are picking on them because this is yet another metric saying they are not doing well. We will do a variation of this view that brings Partner D's write-offs and payments received in proportion to that of Partner F to see how that affects their timekeeper return on investment. First, we change the value of their write-off and payments per billable hour to the same proportionate rate as Partner F. We see that definitely helps bring their profit margin in line with Partner F, but the WIP AR turn and timekeeper ROI metric calculations are still not good. Why is this? Despite the fact that they are pretty close to equal from a profit margin standpoint, Partner D is still carrying a higher average WIP AR balance. There is a cost associated with carrying a high WIP AR balance, and this metric gives a clear understanding as to what that cost is, while also answering the original questions of how much did we sell? And how profitable were we with expenses considered? This is important because the best way to understand your firm's profitability is to make sure your answer is a complete one that considers all the key factors. That is exactly what this metric does, not only for the entire firm, but also by office, practice area, billing attorney, client, and timekeeper, making it easy to identify the areas that are helping or hurting profitability and addressing them accordingly. We can set up any number of views in a format that makes sense for your firm. In our sample model, we created 3 basic views. The first view breaks the information down by practice area, billing attorney, and associate. The second view is by office, billing attorney, and client. Lastly, as we have discussed throughout this video, we set up a view that compares 2 business units. Here is an example of the Miami office versus the West Palm Beach office for real estate only. While we create versions of the report that utilize end-of-month or year-to-date time frames, trailing 12 months, abbreviated as TTM, is the time frame primarily utilized. This is done to smooth out the peaks and valleys of cash collections and expenses occurring throughout the year. The first two columns are billable hours in billing utilization. Billing utilization is calculated by taking the number of billable hours worked and divided them by an 8-hour workday. If a timekeeper enters 10 billable hours in a workday, then their billing utilization is 125%. As with the expense allocations, we take the calculation a step further. Note that we are able to calculate utilization at a client level. We were able to do this because we calculate each individual workday by the clients the timekeeper worked on that day. That means if the timekeeper worked 10 hours in a day and 5 of the billable hours were on a specific client, then 50% of the workday hours were allocated to that client for the timekeeper. Note that each of the clients associated to the one-day example below have the same billing utilization. The benefit of this approach is that when aggregating the trailing 12 months, we can calculate the billing utilization rates by client or by any level throughout the firm's hierarchy. The billable amount column has the amount that could be billed, and next to that are the discounts taken at the time of invoicing the client, and the billed amount is what we actually invoice the client. The billing realization is calculated by dividing the billed amount by the billable amount. Note the client highlighted in red has a billable amount with no amount in the billed amount. This is because it is a contingency case that will not be billed until the case is complete. Also, the two clients highlighted in green have a higher amount for the billed amount than the billable amount. This happens when either billable hours were worked outside of the trailing 12 months or if a case is settled for an amount higher than the billable amount. The write-offs amount column has any amount that is discounted on billed invoices, and the payments column has all payments received in the trailing 12 months. Next are disbursements. The incurred column has all disbursements incurred in the last 12 months. The discounts column has any amount discounted on disbursements, and the payments has payments received on disbursements. We also split out the disbursement by hard and soft disbursement. Hard disbursements are true costs incurred and paid to a vendor on behalf of the client and billed back to them. An example would be court filing fees for an expert witness. Soft disbursements are law firm costs not paid to a vendor but still billed back to the client. An example of this would be work done by the word processing department. The distinction between disbursement types is important because it's a huge red flag when hard costs are discounted. It is not good when soft costs are discounted either, but it's more acceptable. We have partner F discounting all word processing fees in this example. Next, we have the average WIP and AR balances broken down by fees as well as hard and soft disbursements. This is important because later we will show how hard and soft disbursements can be filtered out separately from the metric calculations. The allocated cost can be expanded to show expense account groupings. We have a script that allocates each expense down to the lowest level of the firm's hierarchy, pro rata, based on billable amount. In this example, we show how the West Palm Beach rent expense is allocated to the West Palm Beach timekeeper, Associate N. The billable amount of $360,151 for Associate N accounts for 5.492% of the total billable amount of $6.5 million. The West Palm Beach rent expense totals $304,938 for the past year, which means Associate N is allocated 5.492% of rent expense, which is $16,747. Also note that we split that amount by client so that we can produce a profit and loss statement at all levels of the firm hierarchy with this expense included. Next are the profitability metrics, which show a profitability comparison view, with the profit margin dollars and percent, as well as timekeeper return on investment with and without allocated cost, and WIP AR turn. A key difference in the practice area and office views are the filters on the right that allow the user to filter out disbursements or allocated costs. Those filters also affect the profitability metric calculations. As an example, we will split out the disbursements. First we'll go to the hard and soft disbursements for the payments and take a look at the WIP average disbursements hard and soft. When we go to the right and turn off the hard disbursements, the amount goes to 0 and the payments amount went to 0 also. If we move to costs, each cost can be excluded, and you will note that, not only do the amounts go to zero, but also the metric calculations change. It is just as easy to take them out or to add them back in. The slicers can be used in a very similar way when selecting a specific area. In this example, we will choose real estate. Once that is chosen, all of the numbers in the report are filtered to real estate. The only timekeepers that will show undimmed are going to be the ones that actually have data related to the real estate department. If you want to take a filter off, then it is just as simple to unselect it. We also provide detailed reporting behind each number to help your team with researching any number. As a sample, here is the timekeeper balance detail report that shows the month work is done, when work is billed, when payment is received, and the cumulative balance of unbilled time and the WIP AR balance by month. The detail sheet has each value stored at the customer, location, practice area, billing attorney and timekeeper level to allow aggregation at all levels for analysis. We have written several detailed articles related to the law firm profitability model. You should be able to find the links in the comments section of this video, or you can go to the Enright-McPherran website. To get to the articles, scroll down on the front page, and the first article written is the prologue, which gives a brief introduction to what the profitability model is. Part 1 gives the outline of how the profitability model is built. Part 2 explains cost allocations. Part 3 explains how to utilize the model. To get to each article, click on Learn More and it will open the associated LinkedIn page. Click on the article title to view the detail. To view the glossary of terms, go to Services and click on the Law Firm Glossary of Terms. This gives definitions of the main terminology we use in the articles. If you are ready to move forward, or have questions, then go to the Contact Us page. Leave us your information and we will get back to you within 24 to 48 hours. Thank you for taking the time to watch this video. We look forward to hearing from you and putting this model to work for your firm.